So in today's session, before we get into actual chart patterns, I want to talk a little bit about a trader versus an investor. What is the difference between the two? How might they use chart patterns differently, and get a sense of that? And then after we get through this session, we'll start getting into some chart patterns. I'm going to talk briefly about trader versus investor and the different paths and how each of them might use a chart. So a trader, somebody that's a little more active, they're dealing with shorter term price fluctuations. And this is what we're going to talk about. Do you use a 1 minute chart? Do you use a 5 minute chart? Do you use a 1 day chart, etc.? They're focusing on technical analysis and chart patterns. They're frequent buyers and sellers. So this is somebody that's looking for a good reward to risk ratio. We're going to talk about that coming up in a minute here too, as to exactly what that means. So that's what the trader is doing. Now the investor, they're ones that's leaning a little more on the whole fundamental analysis side of the equation. They're going in, they're looking at the books, they're looking at who the CEO is, what their track record is, all that sort of stuff. And they're going to be looking at longer term charts for the most part. They're looking to hold positions for months, years, decades in many cases. I've got Starbucks from, I think my cost basis is $2 or $3. I've had it for 30 years. So in some cases, we're looking at things like that. And again, they're more passive. They're often using buy and hold strategies, but they're still going to use charts to look for good points to enter or exit trades. So now we're talking about time frame. So going back to your question, Jeff, that surfaced there, when would you use what time frame? If you're an intraday trader, a day trader, which I also did for about 3 years or so back in the late 90s, I'm trading 1 minute bars, 5 minute bars, 15 minute bars. So you're essentially usually doing what's called scalping. You're getting in, you're getting out sometimes in a matter of minutes, sometimes in a matter of 5, 10, 15 minutes. I will tell you from my perspective, two things. One, that is a very difficult game. It can be done, but it is a very difficult game, particularly if you don't have extremely low commission rates. But I'm telling you right now that if you're going in and out of something 15 times a day and you're only getting a few pennies each time, that becomes challenging. So this is best for very low commissions and people that are going to be trading full time, sitting at their screen, studying a chart. And I will also tell you that from my perspective, looking at a 1 minute, a 5 minute, a 15 minute chart, going back to our rule where the more people that see a pattern and recognize that pattern, the more people that see that, the more viable the pattern is. How many people out there do you think are looking at 5 minute charts versus looking at daily bar charts? The vast majority are looking at daily bars. So I don't place as much credence in these patterns if we're looking at 1 minute, 5 minute, etc. So charts with daily bars are ideal for swing traders, people that might hold a position for 4 or 5 days to 4 or 5 weeks to maybe even 4 or 5 months. And they're great for long-term investors. It takes out a lot of that noise, that chopping up and down, and we'll look at what I mean by that in just a second here as well. This is the most accessible type of charting, again, very easy through your platform or through the TradingView platform. And this is the most recognizable patterns that people are going to see because the vast majority of people, when they open a platform, it defaults to daily charts. So that's usually what they're going to look at. Now, you can also do charts with weekly and monthly bars. Those for the people that are really long-term investors. We're not going to be focusing on that for today's purposes. So what's important to note here is that on this diagram over here, all of these bars, those are 15-minute bars, that makes up, all those little bars make up 1 day in the market, okay? So this is where, unless you're a day trader and you really know it, I just call that noise, okay? All those little gyrations during the day don't mean a lot to me. What means a lot to me is that overall candle that gets printed at the end of the day and what that candle looks like in relationship to other candles around it. And that's where we're going to look at some different patterns here coming up in a moment. So I want to talk about the building blocks of chart patterns. This is where we're going to start getting in and identifying what some of the patterns are out there. So patterns are created by supply and demand. Some people call it support and resistance. Okay. So what is support or demand? That's a price level where buyers start overtaking the sellers. In the example where we talked about that candle a few moments ago, where I went and drew on that red candle, that was an example of the sellers overwhelming the buyers as that dropped. So either the sellers got more aggressive or the buyers got less aggressive, whatever. Bottom line is there's a point on a chart or a price point where support comes into play. People come in and start buying it. They say, ooh, that's on sale now. I want to own that. So that's one of the things that happens at the bottom end. Then at the top end of a price point, you hit resistance or supply. That's where people start selling what they have. They're saying, gee, somebody's going to give me this much for it. I'm going to take the money and run. Okay. So that's where sellers start overtaking the buyers. That will drive the price back down, or maybe the buyers just go away. So those are the couple things that will happen that create turning points in markets, which creates ultimately chart patterns, which we're going to look at. Many times those turning points are the footprints of large institutions, your Goldman Sachs's, your Warren Buffett's of the world, coming in, buying or selling hundreds of thousands of shares of something. And if they're selling hundreds of thousands of shares of something, do you think we might want to know that or might want to recognize that? So that's what the patterns are all about. And very briefly here, I just wanted to show this. So this is a channel, and I could probably go back here another year in time. This is a channel that I drew on SPX. This channel was drawn back a year and a half ago. While we did drop out of it a little bit here, and this is not totally up to date, we did drop out of it up here on the tariffs thing. You can see that for the most part, SPX or SPY has been running in that channel now for years. Okay. So patterns matter. When people see drops that start coming down to the bottom of this channel, you start to have people saying, ooh, this is on sale. I'm going to get in. Same thing here. So we're going to look at these types of things on a number of different individual charts, but I just wanted people to understand and see that even in the big picture, even something like SPY or the Qs, you can draw a pattern on there, and many times that pattern will still be playing out years from now. As we get ready to launch into chart patterns in the next session, I'm going to start with my trading plan. In other words, what do I look for before I enter a trade, and how does that impact when and where I get in and out of trades? So look for that next video, and we'll see you there.